Picture a monkey who really wants a bunch of bananas today. He hasn't collected his paycheck of leaves yet, so his hands are completely empty. This is where a credit card steps in. Instead of the monkey walking away hungry, he uses a plastic card, and the bank steps in to hand over the leaves to the banana seller right then and there. Now, the bank expects those leaves back, but they give the monkey a grace period, usually around 30 days, to gather up his own leaves and settle the tab. Notice what's happening here. When you swipe that card, you are not spending your own cash. You are temporarily borrowing the bank's money. Every transaction you make with the card is a short-term loan that requires a future repayment. Moving from cash to credit shifts the physical and digital risks of a transaction away from your personal savings. If someone steals your card and goes on a spending spree, they aren't draining your personal checking account. They are stealing the bank's money. And because it is the bank's own money on the line, they act incredibly fast. They will actively step in, freeze the card, and block those fraudulent transactions to protect themselves, which ultimately protects you. That makes credit cards a financial firewall. They absorb the risks of theft and scams, leaving your actual hard-earned cash perfectly untouched. Now, banks don't just hand out loans to everyone. This gauge shows what we call a credit score. It's a number banks use to measure how reliably you pay back your debts. As you can see on the scale, a score above 740 is considered good, while anything dipping below 580 is a red flag to lenders. When you maintain a high score by paying things back on time, banks trust you more. They will let you borrow larger amounts of money, and they will offer you access to their premium exclusive cards. To win your loyalty, banks pack these cards with rewards. Every time you use the card, they offer you kickbacks in the form of travel miles, points for hotel stays, or direct cashback. They even offer bonuses to get you through the door, promising a large chunk of points if you spend a specific amount in your first few months of holding the card. It creates a rewarding cycle. By proving you can handle borrowed money responsibly, you earn upgraded borrowing power and free perks just for buying the groceries and gas you were going to buy anyway. But there is a catch. If you miss that 30-day window to pay back what you borrowed, the bank hits you with a fee for using their money. This is called interest, and banks use a specific math trick called compound interest. This diagram represents a starting debt of exactly 100 individual leaves. Compound interest means you aren't just charged a single fee on that original pile. You get charged on the new, constantly growing total. Let's say your bank charges a 2% monthly interest rate. If you forget to pay for a month, the bank will add 2 leaves to your debt. You now owe 102 leaves. In month 2, things shift. They charge 2% on the new total of 102, so they add 2.04 leaves. Now you are up to 104.04. By month 3, they take 2% of that larger number, adding 2.08 leaves. Your debt is now 106.12. Every month, the fee calculates on a bigger number, accelerating the daily debt growth. The bank might tell you that you only need to make a tiny minimum payment right now, but those fractional payments usually just cover the new interest fees. You aren't actually shrinking the original amount you borrowed. On top of that, banks can drain your money with other charges, like late fees, annual fees for owning the card, and extra costs in foreign countries. If left unchecked, compound interest takes a small purchase and accelerates it into a debt cycle that becomes harder to escape with every passing day. The benefits and risks of this system are determined by how you choose to interact with it. The first rule of survival is simple. You must only use the card to buy things you already have the cash on hand to pay for today. Next is a concept called credit utilization. This progress bar shows your total borrowing limit. To keep your credit score strong, you should aim to stop spending well before you hit that 30% mark. You also need to actively track your daily expenses. Look at where your money naturally goes, and pick a card whose specific reward system aligns with your natural spending habits. You can ensure you keep every reward and avoid interest by setting up a reminder and paying your balance in full every single